Alrighty. Good evening, good afternoon, good morning. So I'm going to time myself so I stick to 15 minutes or less of talking about fair value gaps. Fair value gap is a very, 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 very important confluence that we use to enter into trades. I almost don't ever enter into a trade without this confluence. It's that important. And I'm going to be repetitive in this 15 minutes, but it's important that you know that so that you are successful in trading. So a fair value gap is a 3-candle pattern where the middle candle, or the second candle in the middle, moves so aggressively it actually creates a gap between the first and the third. This gap between the first candle and the third candle is your gap. That's your fair value gap. It actually acts as an imbalance. It means that second candle, when it moves down, it moves so big, it moves so fast that price wasn't able to fill that gap initially when the gap was created. So this is important. Why? Because we're talking about price moving too fast, leaving an imbalance. This causes price to want to go back and fill that imbalance. And I've put that there is high probability for an entry zone, meaning that if a fourth or a fifth or a sixth or a 10th or a 20th candle after that third candle enters into that gap and closes in the direction that you want to trade, you're going to have a high probability of entering that and making money, basically. Looking for those fair value gaps lets you know that you're trading like a professional. You're trading like what they call institutions trade. You're trading like the big dogs, the traders, because these are things that they use to enter into trades that gives them the confidence and really gives them the profit that they receive. All right, so, and I'm going to draw all of this in a chart. If it's a bullish fair value gap, then the gap between the candle 1 and the third candle, the middle candle is pushing up aggressively. It's going to leave a gap between the first and the third, and the middle candle, which is the second one, is going to be green because we're going up. If it's a bearish fair value gap, it's going to be the middle candle pushing down aggressively, leaving a gap between the first and the third candle, and that middle candle is going to be red. That's all you need to know there. So the way to find a gap, and again, I'm going to give you like a bunch of examples, is you're going to look for 3 candles together. Look for a strong push, like a strong big candle. That's the second one, either green for going up or red for going down. And the next thing you're going to look for is you're going to check for a gap. Is there a gap or a space between the first candle's wick or the end of the candle and the third candle? Is there a gap there at all between the first and the third? Or do the wicks overlap each other on the first and the third? If the wicks overlap, there's no gap. If the wicks do not overlap or the candle doesn't overlap, you have a gap. And the way for you to recognize the gap is to draw a rectangle from the first candle's bottom or top to the third candle's bottom or top. And this will be based on the direction in which the middle candle is moving. Then, after drawing that box, you have to wait for a 4th, a 5th, a 6th, a 10th, a 15th, a 20th candle to enter into that box and close going in the direction that you expect price to go into. That is a true, complete fair value gap. It's not just enough to have the box. You got to have a candle go inside. Then we talk about a good fill. What is a good fair value gap versus like a not so good fair value gap? A partial fair value gap is when price enters into the gap, but it doesn't go through entirely. It kind of goes halfway through the gap. A full fill is when a price enters into the gap, completely filling it, maybe even having a wick go outside of the gap. And then a trade through, which is what we don't want, is when the candle not only gets into the gap, but the gap, it goes above the gap or below the gap, depending on the direction that price is going, and the candle's body actually goes outside of the gap. That's when we don't want to use that fair value gap. Consequent encroachment basically means halfway through the actual gap. It's not important to memorize that, but I will show you what it looks like. And we've talked about it. When you see a bullish market structure, you're going to look for a fair value gap. You're going to wait for the first and the third candle. Look for the gap in between the first and the third candle. Make sure that middle candle is green. Once you find the gap between the first and the third candle, draw your box. Once you draw your box, you're going to have a candle. You're going to wait until a candle goes into that box, but not just goes in, comes out in the direction of how you want price to move, and then you're ready to take your trade along with other confluences. Same thing with the bearish. And what makes a really great fair value gap is when that second candle in the middle is nice and tall, like a good chunky long candle. It causes a really nice gap. That's a good one. You also, when we're looking at the 4 hour and the 1 hour, if it's a gap that aligns with our overall daily bias, it's good. Again, if it's a gap that comes at the kill zones or the key times that we trade, which is 7 a.m., 8 a.m., 9:30 to 10:30, 1:30 to 3:30 or 4 o'clock, 2 a.m. to 5 a.m. If the gaps are formed then, that's what we're looking for. All right, let us go to some examples. This is great if you want to take a screenshot of this. It's basically a summation of what I just said. Fair value gaps can be found anywhere. They can be found on any time frame. They can be found on any stock. I don't care if you're looking at Apple, gold, crude oil. They can be found on any session, whether you're looking at Asia, London, pre-market, you're looking at Australia's session. You can find fair value gaps everywhere. You can find it on the 1 minute, on the 5 minute, on the 15-second, on the 4 hour, on the daily, and the monthly. You can find it everywhere. But just because you can find it everywhere does not mean you need to trade it anytime you see it. Fair value gaps are only useful to us when you look for it during the liquidity times. When we look for it when it's near a key level, like your Asia high, your Asia low, your London high, your London low, your 4 hour highs, your 4 hour lows, your 1 hour highs, your 1 hour lows, your relatively equal highs, and your relatively equal lows. Those are the only times we care to see a fair value gap, right? So the right time and the right key levels. This is a very important confluence. As I've said, you're looking for 3 candles. The first and the third candle form the gap. Keep in mind that the middle candle has to be the color of the direction in which you're going. The colors of the first and the third candles do not matter. Only the color in the middle matters. The gap is only a true fair value gap when the 4th or 5th or 6th or 20th candle enters into that gap and closes in the direction that you want it to go in. The fair value gap is not valid, or it's considered disrespected, or it's considered inversed when a candle actually closes outside of the gap, going in the direction that you're not interested in trading in. That's called, on the PowerPoint here, it's called a trade through. It shows reversing, that maybe price is actually not going in your favor. It's also called disrespected. It's also called inverse, and I will show you all of that. I also put a little something here saying inverse fair value gap is when your gap actually gets disrespected and goes in the opposite direction. So sometimes if you don't see an actual fair value gap, but you see an inverse fair value gap, you can use the inverse fair value gap in place of a regular fair value gap going in your same direction, and I'm going to explain all of that here. Let's look at some examples. We're currently on the 4 hour chart, and I'm going to just find fair value gaps everywhere, and then I'll start looking for them on the time frames where we trade, because I just want you to see examples. I'm timing myself here. It's been 10 minutes. All right. 1 candle here, 2 candle here, 3 candle here. There's a wick right here. There's a wick right here. All of this is a gap. I'm going to take my rectangle, place it right here, and I'm going to drag it down all the way. I'm focused on this wick and this wick. I'm just going to drag that rectangle down and stretch it out. Once I stretch it out, I see a candle enters here. This candle that enters into this makes this a fair value gap. Something has entered here. And what I want to see is a candle come back out. So you've got this candle that goes in. Remember that a green candle opens at the bottom, closes at the top. But a black candle opens at the top, closes at the bottom. So essentially, this candle here opened up, went up and down, and closed kind of close to here. Then this next one opened over here, it went up and down and closed down here. Once that happens, you're able to get into this trade because this candle, these two, let me know that this gap that I created between this first and this third is valid. Let me show you another one. Candle here, wick from the first, wick from the third. Take this rectangle, drop it there, leave it. And you can stretch it. But now you look, there's no candle that's touched it. Is this a fair value gap? No, this is not a fair value gap. It's a gap that at some point price is going to want to enter back into and recognize, but clearly since February 3rd, it has not seen this as a valuable gap yet. It's seen this one, it hasn't seen this one. Okay, let's go to this one. Candle here, this is the first candle, this is the third candle. And notice that this first candle does not have a wick. This one has a wick. Does it matter? No. I'm still going to take the rectangle, click it there, and I'm going for this wick down here. Remember, you're drawing the box for the first and the third. Once you do that, you stretch it out a little bit. And now I'm looking for any subsequent candles that enter in. Right off the bat, the fourth candle enters in, the fifth candle enters in, and it comes out, I'm entering my trade. Because this is a validated fair value gap. Let's look going up. Sometimes I gotta look for it. Let's look for it. Going upward. And again, nobody cares what the first and the third, nobody cares what the first and the third candle look like. We're only concerned about what the middle candle looks like. Okay. We've got a candle here, wick here. Click the rectangle because I see a gap. And sometimes if you're not sure if you see a gap, just go ahead and draw it. Because if you can identify your wick here and your wick here, draw your rectangle, you'll have that vision. Until you start doing it more often, you can recognize it without having to draw it. But you draw it out and then you follow the candles, and here you go. You've got this candle that opened up down here. How did it open? Oh, no, it opened up down here, closed down here, but it entered here. That's perfect. And then you have this one here that actually opened up here, went all the way into this fair value gap and closed up. This would be my entry, or this one would be my entry. This is a valid fair value gap. Let's find another blue one. Price has been more bearish than bullish, so I'll keep that in mind. So sometimes to find a bullish one is a little bit challenging. This one's a little tricky, but it's still a good one. We've got a candle right here, third candle right here, the wick up here, the wick over here. Click the rectangle, click it on the first one. I'm focused on this wick right here, but I'm just dragging it out. Okay, third candle, fourth candle doesn't enter, fifth candle doesn't enter, sixth, seventh, eighth candle enters in, closes out. I can enter into this, or I can enter into the next. Obviously, if you stretch it out, you can tell that price ends up coming down a little bit more beyond this gap, but it still ends up rallying up. We don't know what's happening in the future. All we're going to do is focus on what we have right now. So If you're not seeing anything to the right of this candle or to the right of this next candle, that's fine, because we can't tell the future. But pretend like you can't see any of this, and you just see this candle enter into this space, and you see this candle outside. You would enter in on this trade and take it up. You would set your stop loss just as a freebie up here or down here, because this is a swing low. Set your stop loss. That way, when this price comes down, it's not going to go, look at it, it doesn't go all the way up here, and it still goes in a direction. You can still make money. All right, now I'm going to show you an inverse fair value gap, where you think you're drawing your fair value gap to go up or down, and it actually goes in the opposite direction. Actually, let's say I don't see a fair value gap. I'm looking for something to inverse my gap. These are kind of too far apart. Yep, here we go. You've got this candle first, this candle the third. The middle candle is green, so you're expecting to go up. Click on this first candle, draw it to this third candle's wick all the way across. So the third candle makes this a gap, right? Now we're looking for a candle to enter in. We're getting close, we're getting close. We get this candle, it doesn't enter, but it's right at the line of this box, and then we get this candle. So remember that this candle right here is green. We were expecting price to go up, but then we get this candle. Not only is it black, which means it's going in the opposite direction that we wanted, not only has it entered into the gap, which we like that it entered into the gap, but now you can see that its body is outside of the gap. This is an inverse fair value gap. This means that price looks like it's going up, but we have a down candle that has inversed and invalidated the up. This gap was supposed to prove to us that we are going up because the middle candle is green and there's a gap. But now we have a black candle that has closed underneath it, so now this is telling us it's going down. And if I look over, even though this is a nice gap between this and this candle, there is no other candle that enters into this space during this time. So this candle, if I see this candle go through this gap and close outside of this gap, I'm going to prepare myself and turn around. Instead of taking a trade up, I'm going to get ready to take a trade down instead because of this inverse. Let me find you one more and then I'm done. Actually, I'm going to reset. I'm going to show you one on the 1 minute, because this morning was just like that. I had this morning at perfect. This is 9:30, right over here. Okay. Price opens up, it comes up, it comes up. Nice big green candle here. Now, I already knew, because there was some key level over here. This white line, there was some key level over here. I knew that price was I figured, or I predicted, or my experience told me that with this key level up here, price is going to go up and reverse. So I started to look for inverse fair value gaps. So I see this first candle, this third is green, and the second is green, the third is green. Now, like I said, I was expecting price to go over this key level and come down. So even though I drew a fair value gap right here to this, and I drew it across, I was waiting for price to come through this and close down. This was my inverse. This is how I took the trade all the way down. I did not need an actual fair value gap. I chose to use this really good fair value gap, wait for it to get inversed, and I entered in my trade on this candle or on this candle. I'm not sure which one. And again, the reason why I did that is because I looked here for a gap. I saw a gap right here, but no candle entered. And it was at a key time, key level where this is an important key level. Liquidity has been taken. We're going to start heading down. Even if I waited down here, I still don't have a fair value gap. But I have this really beautiful inversed gap here that I used to enter into this trade. Okay, I hope that makes sense. This is your homework. Homework. Please find 5 fair value gaps, and I'm abbreviating. Please find 5 inverse, I'm going to put an abbreviation, inverse fair value gaps. It doesn't have to be all bullish or all bearish. I would say do a mixture of it, but definitely look for 10. Look for 5 regular fair value gaps and 5 regular inverse fair value gaps, and I'll see you in the next one.